Welcome to Staffworks Explained. If you're here for the first time, please consider subscribing to this channel. You can also hit the notification bell so that whenever we do a video, you are among the first people to be notified. In this video, we'll be looking at Equity Group Holdings performance, the bank or a company that is termed to be one of the most profitable in East and Central Africa. We'll take a closer look at this bank, which is the most influential banking institution, the Equity Group Holdings, which is seen even in the terms of success in East and Central Africa. It has built its name on scale, innovation as well as financial inclusion. But with its latest financial results now released, the conversation is shifting from how fast the bank is growing to how sustainable that growth is. So we'll walk you through the numbers, examine the regional operations, as well as look at how or what is driving this performance and what could challenge it, as well as where the bank is headed in the next. Let's look at the big picture. Let's start by that. Equity Group Holdings operates in 6 countries in East and Central Africa. We have Kenya, which is the home of this company. We have Uganda. We have a subsidiary. It has a subsidiary in Uganda, Tanzania, Rwanda, South Sudan, and DRC Congo, where it's one of the most profitable. It serves millions of customers across the region with a model built around accessibility, especially for individuals and small businesses that traditional banks have often overlooked. Today, the group controls a total asset of Kenya shillings 1.7 to 1.8 trillion, placing it among the largest financial institutions in the region. And importantly, it is becoming less dependent on one market, a shift that is central to its long-term strategy. Let's look at the results, which we described as strong but under pressure. The latest results show continued growth, and at first glance, they are impressive. Profit after tax about 75.5 billion Kenya shillings. Pre-tax profit was around 92.1 billion Kenya shillings. Net interest income was approximately shillings 126.9 billion Kenya shillings. In simple terms, the bank is earning more, largely from lending, but the environment is started tightening. Higher interest rates mean borrowing is more expensive and more customers are struggling to keep up with payments. This is reflected in the rising non-performing loans. Those are loans that are not being paid. To cushion itself, the bank set aside provisions that at one point reached around 29 billion Kenya shillings before easing to about 14.5 billion Kenya shillings. So while profits are rising, the cost of managing risk is rising. Let's look at the balance sheet of this company and what supports the growth. Looking deeper into bank structure, customer deposit over 1.3 trillion, loan book of more than 800 billion Kenya shillings. The deposits reflect trust, loans reflect activity. Equity is strong on both, but the more it lends, the more exposed it becomes if conditions worsen. The balance is becoming even more delicate. Where is this growth coming from, and where is it going? One of the most important developments is regional diversification. At this point, about 45% profit before tax comes from subsidiaries outside Kenya. Nearly half of assets, loans, and deposits are now generated regionally. This is a major shift from a Kenya-dominated model. The standout market is Democratic Republic of Congo, which has contributed an estimated 13.8 billion Kenya shillings in profit, and this is growing rapidly. Other markets like Uganda, Tanzania are also expanding steadily, while Uganda continues to grow its loan book. Back in Kenya, the bank remains the anchor, still the single largest contributor to profits, but no longer dominant in the way it was before. What is its future plans, the future expansion, or the next frontier? Looking ahead, equity strategy is clear. Deepen presence in existing markets, especially the DRC, which is expected to become one of the group top contributors. It is also looking to expand further within Central Africa, where banking remains or penetration remains low. It is also looking to strengthen regional trade financing, supporting businesses operating across the borders. There has been strong strategic interest in Francophone Africa, countries beyond current operations, though expansion here is expected to be gradual and selective. The goal is not just to enter the new markets, but to build scale in high growth underbanked economies. The goal is not just to enter these markets, but to also see high growth. What's the future profit mix? Where is the bank heading? Right now, Kenya is still slightly over half of total profits, but going forward, the expectation is clear. Regional subsidiaries could contribute more than 50% of the group profit in the coming years. DRC alone could drive Kenya as the top earnings market if current growth is sustained. In simple terms, equity is transitioning from Kenya-led bank to a fully regional earnings model that reduces concentration risk but introduces new complexity. What makes equity different? Equity model remains its strongest advantage. It's built its foundation serving ordinary people, small traders, informal businesses, and low-income earners, then scaled through technology. Its digital platforms and agency banking network allows customers to transact without traditional branches, keeping costs low and reach wide. Leadership has also been central. We have the Chief Executive Officer, James Mwangi. The bank has maintained a consistent strategy over the years, something that has helped it expand without losing direction. But we have the Rwanda fraud case, which is a warning sign. Not all signals are positive. In Rwanda, the bank faced a fraud incident linked to weaknesses in internal controls. Financially, the impact may be small, but compared to the annual profits of over 75.5 billion Kenya shillings. But the real issue is confidence. Because banking depends on strong systems, and when those systems fail, even in one market, it raises broader concerns. It is a reminder that rapid expansion must be matched by equally strong oversight. What are the risks ahead? Looking forward, several risks stand out. One, we have rising interest rates putting pressure on borrowers. We have expansion into volatile markets, increasing uncertainty, and then there is potential rise in loan defaults, greater scrutiny on governance and internal control. At the same time, competition is increasing, and maintaining growth will become more demanding. In conclusion, we can say that we can ask the question, where does this leave equity groups holding? It remains one of the most powerful financial institutions in the region, with Kenya sharing 75.5 billion in profit and over 1.7 trillion in assets, as well as a rapidly expanding regional footprint. But the story is evolving. This is no longer just about expansion. It's about managing transition from local to region, from rapid growth to controlled growth, from opportunity to complexity. The future of equity will not be defined by how fast it grows, but by how well it manages business that is now spread across multiple economies, multiple risks, and multiple realities. So thank you for reaching this far. If it's your first time here, please consider subscribing to this channel. You can also leave or hit the notification bell so that when you upload a new video, you're notified. You can also leave a comment on what you think about this performance by Equity Group, where it made one of the record profit in East and Central Africa, surpassing companies such as Safaricom and Kenya Commercial Bank in the region. So thank you, and let's meet in the next one.